Welcome back, everyone. We are on the home stretch, decoding one of the most powerful stock-picking systems ever created. Today, we are tackling the second-to-last letter in CAN-SLIM, I for institutional sponsorship. All right, let's get right into it.
You know, it's easy to feel that way. But what if I told you that the biggest players out there, the absolute whales of the market, leave a trail that you can follow? See, institutional sponsorship isn't something to be afraid of. It's about learning to ride the massive waves these giants create.
So if we're going to follow their lead, we first have to be crystal clear on who they even are. Let's break down what institutional sponsorship actually means.
At its heart, it's actually pretty straightforward. We're talking about the big money, organizations that are managing these enormous pools of capital. And when they decide to buy a stock, they don't just dip a toe in the water. No, they buy in massive, massive quantities. And that's the force we're looking to spot.
Now, this right here is a really crucial distinction. Sponsorship is not about opinions or what people are saying. An analyst report might cause a little blip for a day, sure, but that is not the same as a major mutual fund putting millions of real dollars to work by actually buying up shares. We are following the money, not the talk.
Okay, so we get what it is, but why is it so important? I mean, why does this one single factor get its own letter in the CAN-SLIM system? Let's talk about the incredible power of this smart money.
And, this quote from the system's creator, William J. O'Neill, just says it all. These professional investors, they aren't just playing in the market. Their actions can literally define a stock's entire trend. Their influence is the engine that drives those big, powerful price moves.
And here is the number that just blows my mind. Around 70%. Yeah, 70% of all market activity is driven by these institutions. When you're dealing with a force that powerful, it's not a question of if you should pay attention. It's a question of how. Their buying pressure is what can launch a good stock into the stratosphere.
And this is my favorite way to think about how we can spot them. An institution can't just quietly buy millions of shares of a stock. It's like an elephant trying to sneak into a bathtub. It's just not going to happen quietly. The splash, that huge surge in trading volume, is massive and totally obvious to anyone who knows what to look for on a chart.
Okay, so that covers the why. Now let's get into the good stuff, the practical how. It's not just about finding any sponsorship, we want to find quality sponsorship. So, what are the signs we should be looking for?
It really boils down to three key things. First, you want to see a decent number of institutions owning the stock, and ideally, that number should be growing. Second, quality is way more important than quantity. Having a top-performing mutual fund on board is a much stronger signal. And third, this is the big one. You have to see recent heavy buying, what we call accumulation. So the takeaway is this. Don't just follow any institution. Follow the smartest institutions that are buying right now.
Let's look at a real-world example here on this chart. Focus your eyes down on those black bars at the bottom. That's the trading volume for each week. Now look at the weeks where the stock's price went up. See that? See how the volume bars on those up weeks are just so much taller than the others? That's not just a bunch of small investors. That, my friends, is the footprint of the elephant. It's institutional accumulation, clear as day.
Now, to make all this even easier, O'Neill's system has a special tool built just for this, the Accumulation/Distribution Rating, or AD rating for short. It's a simple A through E grade that does the hard work for you. It analyzes price and volume to tell you if a stock is being bought up or sold off by the big guys.
And honestly, the best way to think about it is like a traffic light. Super simple. An A or a B rating, that's a green light. It means institutions are buying. Go. C is a yellow light. Maybe slow down, be a little cautious. And a D or an E, that is a big flashing red light. It's telling you institutions are selling, and you should probably think about doing the same.
All right, you've seen the theory, you've seen the tools. Let's lock in all that new knowledge with a quick 2-question quiz, just to make sure these key ideas really stick. You ready?
First question, which of these is the best example of real institutional sponsorship? Is it A, an analyst report, B, a mutual fund actually buying more shares, or C, a newsletter recommendation? I'll give you a second. Okay, if you picked B, you are absolutely correct. Remember, it's about real ownership, real action, not just opinions.
Question number 2, you pull up a stock and it's got an AD rating of A. What's that telling you? A, heavy selling, B, heavy buying, or C, it's just kind of neutral?
The correct answer is B, heavy buying. An A rating is the strongest green light you can get. It means the institutions are piling in.
Fantastic work! And just like that, you've mastered the I in CanSlim. You are just one step away from having the complete framework. And trust me, we have saved the most important letter for last.
Here's the thing, and this is so important. Even the absolute best stock in the world, with perfect fundamentals and tons of institutional buying, can still get crushed in a bear market. That's why the final letter, M for market direction, is the key that unlocks the whole system. So make sure you subscribe because you do not want to miss our final deep dive where we cover the most critical letter of all.
In fact, you can get a head start right now. Just click the link on your screen for our deep dive on the M in CanSlim. Thanks so much for watching, and we'll see you in the final explainer.